Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but I'm trying to teach you every day. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. At this point, we've heard from so many billionaire critics saying that the artificial intelligence data center build-out is an outrageous bubble that it really has become terrifying, hasn't it? This promotional pessimism, as I'm calling it, is the kind of thing that scares people away from owning stocks, scares you away. And now I think it has become a beastly overhang on the entire market, although that bearish AI shroud was not enough to frighten us today as the Dow gained 300 points, S&P climbed 0.59%, and the Nasdaq advanced 0.44%. Now, I've heard this gloomy chorus in the background during some of the most dazzling stock performances I've ever seen in my life. I've never advocated the negative position, the bubble, recklessness, so the so-called foolish spending, partially out of respect to the leaders of the so-called hyperscalers. The trillion-dollar companies that are spending fortunes building out their AI data center networks because they think that that's where the opportunity is. I will not call it a bubble because I trust the judgment of Jensen Huang. He's the CEO of NVIDIA, who's arguably the father of both accelerated computing, which does matter tremendously, it's not talked about, and generative AI. Jensen's been met with skepticism every step of the way, and the skeptics never seem to learn, even as he constantly proves them wrong. And I think he's doing so again. Even though the data center spend is admittedly humongous, you got to keep in mind that it's coming, for the most part, from the vast cash flow of the richest companies on Earth. They're not borrowing money. Lately, though, some build-out plans announced by Sam Altman's OpenAI and Oracle, founded by Larry Ellison, now with two CEOs, have caused some trepidation because they're spending well in excess of what they can afford. Now, I've got to tell you, I actually am uncomfortable with that. But again, when I hear Sam Altman talk on our network in a great interview with John Ford about the demand that he has, when I know NVIDIA's roadmap for a reasoning semiconductor platform, one that can comprehend and actually help your advanced thinking, okay, and maybe be ahead of you with complex problems, I have to suspend a guilty verdict, or at least I intend for Mad Money to stay open-minded. So don't call me a cheerleader. But I believe that AI is getting better and better and better and will be worth every penny when things shake out because Jensen Huang has assured me, and I have no reason not to trust him. Plus, unlike the dot-com era internet build-out, which was often financed by vendors, it's called vendor financing, or lightly financed by shaky institutions, the data center build-out's largely funded by the smartest people on Earth who are running the richest companies on Earth. The CEOs of these companies believe AI will be the next industrial revolution, and they know. I, for one, am not smart enough to doubt them. I own that. I don't have that. They've made us too much money, though, to think that they've all lost their minds. Of course, not everybody's going to win. Could there be more than one winner? It's something I was working on all this week when I talked to those CEOs. When the dot-com con imploded, we still did get Amazon and Google, though Google came public years after the bubble burst. Maybe we can get 3 or 4 winners this time around. That wouldn't shock me. But they all want to win the race for the best AI because they're terrified they'll be left behind and they'll never be able to catch up. And you know what? They won't. So when you hear these critics warn of a disastrous bubble, keep in mind that even though many of these bearish money managers who come on TV and talk their negative book are smart, they don't know jack about tech versus Mark Zuckerberg, Satya Nadella, Andy Jassy, Elon Musk, and they can't hold a candle to Jensen Huang. There. I said it. I had to. To not acknowledge the critics is to say, you know what, I agree with them. But that doesn't mean I should necessarily obey them hook, line, and sinker. And I don't. As I say in How to Make Money in Any Market, which goes on sale next week, Bafo signing by me at Barnes & Noble, 555 Fifth Avenue, noon Tuesday. Get your reservation. Hope to see you. The billionaires, they're not working for you. They're not. Even if they genuinely believe that you may really think that they're trying to help you, but you've got to understand, once you're that rich, you become incredibly risk-averse because there's no need to take risks. A responsible billionaire will almost always pretty much default to bearishness when they come on air. Once you are that rich, it seems you can only see the worries and not the opportunities. So stop being swayed by their negativity and think this. Why didn't you become a millionaire like so many NVIDIAns I know? I know the answer. The people, these people, the billionaires, the analysts, they all came on and they scared you. They scared you and they got you to trade out of a phenomenal stock that you should have just owned and not traded. Did they apologize? Maybe I missed it. Okay, enough soapbox, but I had to do this because it's all I hear anymore. No matter where I go, it's all I hear. Now, we got a game plan. Let's get to it. On Monday, we've got reports from two oddly important companies, Carnival and Jefferies. Carnival, along with the rest of the cruise industry, has been in super bull market mode ever since the end of COVID. Can it continue? I actually think so, led by Royal, by the way, because consumers know that cruises are relative bargains when it comes to leisure travel. Jefferies is a boutique investment bank that does a ton of financing. The investment houses have been among the best performers in this market. There's so many. I mean, so EA may take itself private. There are just huge banking deals everywhere. Jefferies will help us figure out if these moves are justified. Tuesday morning, we hear from a company, I think, that tells you more about the state of the economy than almost any other, and that is Paychex, which you're quite familiar with if you watch the show. Payroll processor and human resources company for millions of small and medium-sized businesses, proverbial backbone of America. Now, it's not as important as the non-farm payroll numbers Friday, but I think Paychex tells you it straight. I devour the report every quarter. During midday, I'm going to leave my post here and go to 555 Fifth Avenue to sign books. You have to reserve to do it. I hope to see you there. The book is meant for you, to make you a better investor. Tuesday night, we hear from the most important company of the week, and that's Nike. This company is being reinvented by new CEO and old Nike hand Elliott Hill, whom I've met and I respect. I don't know if this will be the breakout quarter, but there will be a breakout for Nike, and you have to buy it ahead of that, as I've told members of the CNBC Investing Club. Our club bulletin from today, Jeff Marks, great job, gives you all you need to know about the current Nike state of play. Next, I am concerned when I see outsized dividends versus the rest of the market. UPS, for example, sports a 7.84% yield, which seems darned high, way too high versus the rest of the S&P to make me comfortable. Something's awry. You know what? I'm beginning to feel the same way about ConAgra, with its 7.7% yield. It reports Wednesday. ConAgra makes money. It has a lot of solid brands, but the street's looking for down earnings, and that would be untenable. It is time for a statement, upside surprise, plain and simple from ConAgra. That's the only thing that will reverse that hideous slide of their stock. Thursday, we get a raft of data. Aggregate car sales, weekly jobless claims, durable goods, all important, but everything pales in comparison to Friday's non-farm payroll report. As I've told you from day one of this show more than 20 years ago, I don't pay much attention to any of these numbers because it's the Fed that's scrutinizing this. If there's too much wage growth, the Federal Reserve has to say it needs to pause the rate cuts to see if the inflationary infection can go away on its own. So a hot number will put Jay Powell back in the box. He's got a president who won't stop criticizing him. He has a budding slowdown, but he also has a boom because perhaps that's the one that's connected to the data center build out. It's not built on borrowed money. Amazon and Alphabet and Meta don't need no stinking interest rates. But the bottom line, the employment number lords over all other entries here. Call me concerned because I know that some parts of the economy, anything connected to this data center, are overheating. But another part, autos, homes, retailers, dreadful. Can Jay Powell save the rest of the economy without taking the data center economy to a boiling point? Well, you know me. I think he's done a pretty good job so far. Let's hope he can keep it up. And I am an optimist. Let's go to Jeff in New Jersey, please. Jeff.
Hi, Jim. Happy New Year. Jeff from Central New Jersey, also known as Dr. ECE, fourth to the ring. Shout out to the ace and the Casino Combat Metaverse.
Excellent.
I can't thank you enough for dramatically increasing my net worth and creating intergenerational wealth.
See, again, I mean, this is like when I talk about in how to make money in the market. People have made a lot of money in individual stocks, but no one wants to believe them. I thank you for saying it. I see people 10, 12, 15 a day who make money in individual stocks, and we're listening to one right now. He's not making it up. Jeff, how can I help you?
I'm taking a haircut on this club stock. I'm now seeing ads for its promising new drug. A psychiatrist friend called Cobenfy a game changer. Should I add to my position of Bristol Myers?
Well, we're going to hear from J&J later in the show. They have a competitor. I have said, and I've been abject about it, that I think I might be wrong in Bristol. That's why I've not added to it. J&J is doing a better job than Bristol, and it's rankling me. Let's listen to J&J. We're not afraid to take a loss if we have to, but we're not giving up yet. Thank you for those kind words. And again, evidence that individual stocks have made, with homework, a lot of money for a lot of people. The non-farm payroll report next week lords over all the other data. And they will, and you know what, we're going to see if Powell can continue doing what I think he's done a pretty good job, Well, Mad Money tonight, looking for a data center play that isn't all that obvious? I'm taking a look at one new-to-me stock and giving you my take on the company. Then with all the AI plays out there, it can be hard to separate the wheat from the AI chaff. I'm looking at one newcomer to the space, and it's worth your time. And President Trump just announced new tariffs for pharmaceutical companies that don't have plants in the U.S. I'm sitting down with the CEO of J&J, as I just mentioned, to get a closer look at the company's plans to invest in American innovation. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.